Hi, I'm Richard Jeffries, and I'm really excited to be bringing this webinar to you about all things you need to know when applying for a home loan to buy your first property. I've been mortgage broking over 18 years and very fortunate to be doing it that long. And as a broker, our role is to guide you through the mortgage maze. That's how we see it. We get paid by the lenders, and we have a number of on our panel, over 25 that we deal with. Probably the biggest value we can offer, though, is helping you understand what sort of deposit you required, what sort of loans you go for, how much can you borrow, what do all those things mean, what are the pitfalls you need to avoid. They're going to be the things that we're going to cover, because there are some common mistakes that are often made. I'm going to start by sharing my screen and the slides that I've got for you. But as I mentioned, we're really going to be covering off all things related to finance when buying your first property. And the way that we do that is through the 5 L's of lending. So we're going to be covering off your level, which is step one. How much can you borrow based on the deposit you've got and your income and expenses? Then step two is the type of loan you should look at. Step three is which lender. Step four is lodging your application. Step five is reviewing your loan on an ongoing basis, which is something we do for our clients because that's really important over the life of the loan. So the big questions we're going to be aiming to answer are, how do banks decide how much you can borrow? What are the metrics they use in doing that? And how can you sort of use that to your advantage and by understanding that? And how much deposit do you need? What is the right type of home loan to choose? Should you be looking at a fixed or variable home loan? How do you compare interest rates accurately? You should do that. And what happens once your application is sent to the bank? So to kick all that off, we're going to start with your level, as I mentioned, as part of our 5 L's process we've developed. And when we talk about your level, the first part of that, there's 3 parts to your level. And the first part to that is your deposit. That's really important because that determines the level of buffer that's in the property for the bank. So if you think about it, they're lending you money and they want to know what the value of the property is, and they want to know as a percentage, how much deposit have you got in relation to that value. So if you have $100,000 deposit, as in this example, and the property is worth $500,000, then you have a 20% deposit and they're only lending you 80% of the value. If you only had 5%, they'd be lending you 95%. And really 5% is the minimum. But if you have less than 20, they see that as a higher risk. So they take out mortgage insurance to cover themselves. Really important to understand that mortgage insurance is there to protect the bank and cover the bank if something goes wrong. It doesn't cover the borrower. So now, with regards to being a first home buyer, there are some government incentives in place to try and help you along the way. And they are largely around your deposit. There's some stamp duty concessions, mortgage insurance waiver, which is referred to as the first home loan deposit scheme, and some first home buyer grants. Stamp duty concessions will vary from state to state. But basically, stamp duty is a tax the government charges whenever you buy a property. If you're a first home buyer, if it's under a certain threshold in a particular state, you may be able to avoid stamp duty altogether. In Queensland, that threshold is 500,000. You've got to be under to pay no stamp duty. If you're under 550, you get a discount. In New South Wales, you've got to be under 800,000 to pay no stamp duty. If you're under $1 million, you'll get a discount, and so on. Important to note that, that figure could save you easily $10,000 or more in a lot of cases. So really important to understand whether or not you qualify for the stamp duty concession. The mortgage insurance waiver, number 2, as we said, the first home loan deposit scheme, that really refers to being able to avoid mortgage insurance if your deposit is less than 20%. So there's a good website that it's referred to as the first home guarantee or first home loan deposit scheme. And to be eligible for that, it's listed on the website. So as you can see, obviously Australian citizen, permanent resident, 18 years of age. But the other interesting one is the earning threshold. So you've got to be under 125,000 if you're an individual, under 200,000 if you're a couple. You've got to be intending to live in the property. There are some other conditions with the property, and that is that there are property price caps, a little bit like stamp duty. So for New South Wales, if you're in a capital city or regional centre, which is Newcastle and Lake Macquarie and Illawarra, then if you're in those areas, property's got to be under 900,000. For the rest of the state, it's 750. And Victoria, if you're in Melbourne, you've got to be under 800,000 or Geelong. But if it's the rest of the state, it's 650,000. Queensland, Brisbane, Gold Coast and Sunshine Coast, got to be under 700,000. For the rest of the state, 650 and so on. So you can see stamp duty concessions, mortgage insurance, waivers, all there for you if you're a first home buyer and you meet the criteria, but you do have to stay under a certain level. The other thing to remember with the first home loan deposit scheme only is you do have to use certain lenders on the panel or that are registered for this scheme. Now, you can see it does limit your choice, but there are still plenty of options. The major banks, for example, you've got all of them except for ANZ. So, and then your non-major lenders, there's a whole heap of them. So mortgage brokers like us will have access to the majority of those lenders. When we come along to, the final incentive, just going back a couple of slides, is the first home buyer grants. Now, this really relates in most states to if you're building or buying a brand new property. So this scheme came about to try and encourage new home construction and to help the construction industry. This is really only related to, as I said, first brand new homes. So where no one has lived in the home before. So if a developer's built some new units or a builder's built a brand new home, then it's likely that would be eligible if you're building a brand new home. That's where that grant can come in, and that can be, in Queensland and South Australia at the moment, that's $30,000. New South Wales and Victoria, it's around the $10,000 mark. So they're the three incentives available for first home buyers. So I'm just going to skip through some slides, and we're going to talk about your borrowing power. This is the second part of your level, which is determined, the banks use to determine how much you can borrow. Your serviceability or borrowing power is really determined by the amount of income you've got coming into your household. And these are all eligible sources of income, less your expenses. Now, rent would not form part of this because it would likely go if you were to buy a new property. And then whatever's left over at the end of every month, the banks work out. They look at that and go, okay, well, that's how much can go towards a mortgage repayment. But they will work it out on an interest rate 3% above what you'll be paying. So at the moment, the interest rate's around 6%. They'll work out and see what you can afford on a home loan at 9% to see that, okay, if interest rates do increase, is this borrower going to be comfortable and able to meet the repayments? So that is the second part of your level. And if we have a look at an example on what that means, if you've got a couple, you can see their earnings here. They've got a car loan, which will hurt your borrowing power considerably. Couple of credit cards. Now, important to know, banks will work off the limits of your credit cards, not what's owing, and your living expenses. You can see the lowest amount of the lenders on our panel is about 485,000. The highest is 551,000. So there's quite a difference there in how much banks will lend you. It's not the same. It does vary. You can, by making some changes here, you can really make a big difference on how much you can borrow. If you were to, and we're going to have a look at that. So if you were to, let's say, get rid of the car loan altogether, reduce your credit card limits down from 25 to 5, and reduce your living expenses, your borrowing power goes up to 906,000 in this example. So huge difference in how much you can borrow. And really, that's a really important thing to look at, is if you're saving money and you do have some debts, then it's really a good idea to sit down with us and understand if you should be putting that money towards savings as much as you can, or if you should clear your debts first. We'll be able to show you the likely outcome of both options. The third part of your level and determining your eligibility for a loan is your credit score. All of us have a credit score, and it gets pulled and put together based on credit applications we've made, but also our conduct on any loans we've had, be it credit cards, even telecommunication accounts we've had, car loans, all those things get logged on this credit score system and all the banks can see it. So if you have a loan with Macquarie, if you have a car loan with Macquarie and you apply for a home loan with St George, they can see the conduct of that car loan. So quite simply, it's really important to make your payments on time for any credit cards or car loan facilities you have. You do not want to fall behind by a month or two because that will pull this credit score down from in the green down towards the red, and it may make you ineligible for a home loan. You may have to wait till that score improves. So paying your accounts on time is really important to help your credit score. The other key factor is don't make too many credit applications. So what we mean there is, if you do apply for a credit card, that's fine. A lot of people will do that to try and get points, but you don't want to be doing that too often in shorter period of time. So for example, you would not want to apply for 5 different credit cards within the space of 6 months, because that would show a dependency on credit from the bank's point of view, and that would likely pull down your score. You also do not want to go right up to the limit on your credit card. If you can spend within sort of 20 to 30% of the limit, that's going to show that you've got good conduct, you've got, you're good at managing your finances. So not too many credit applications in a short space of time. One is fine, but yeah, if you do want to get lots of points, you really need to space it out. You can check your credit score. My free credit file, I believe it is mycreditfile.com.au, will show you what your credit score is. Okay, we're going to move on to the next L, which is step 2, which is your loan type. So this is generally the different types of loans in the market. And the good part about this is that all the banks have these different types of loans, so it makes it really easy to compare. The first 4 are variable rate loans. The final one is a fixed rate loan, as it says. Line of credit, I would not worry too much about. That's more for investors accessing equity, but certainly the first 3 will come up fairly often. Now, the difference between a basic and a standard variable and a professional package is really offset account. It's not available on a basic home loan. It is with a standard variable and a professional package. Usually not available either on a fixed rate home loan. So whether or not an offset account is important for you will often go a long way to determine what sort of loan you should look at. The other thing that you need to consider is, do you want to try and pay this loan off really quickly? And therefore you need some flexibility in being able to make extra payments. If you do, a variable loan will allow you to do that. You're allowed to make extra payments with no charge, and you can redraw, so you can pull money back out on those extra payments you do make. Now, if you want to do that, then a fixed rate will restrict you. They may let you make extra payments, usually up to $10,000 a year, but quite often you won't be able to redraw on that. And as I mentioned earlier, you won't have access to an offset account, which I'll explain what that is, how that works in a moment. But a fixed rate will give you certainty around your payments. Most fixed rate home loans run from anywhere from 1 to 5 years. So, for example, if you chose to fix a home loan for 3 years, interest rate is locked in for that 3 years, meaning it won't go up or down and your repayments shouldn't change. Whereas a variable rate loan will go up and down based on usually what the Reserve Bank is doing, but also the cost of funding for the banks to access money. So they can change your interest rate at any time. It's not totally dependent on the Reserve Bank. Usually the Reserve Bank's changes will trigger the banks, but they can make changes outside of that. So if you want certainty, if you really value certainty, then fixed rates may be the way to go. But if you really want to pay the debt off ahead of time, which we would suggest, then a variable will give you that flexibility. We did talk about offset accounts briefly, and this is how an offset account is worked. It's linked to the home loan. So for example, if you had a home loan of assume 500,000 and you had 10,000 in your offset account, the interest charge would only be 490,000. Okay, so whatever is in this offset account reduces the interest charged on your home loan. Interest is charged daily on home loans. So every day you can keep money in that offset account, it'll be working for you. It is a totally transactional account, so it has a debit card linked to it. So whether or not an offset account will work for you, it largely depends on how much you have in there. If you are going to have a lot of funds in there, then it will reduce the interest you pay considerably. If it's only going to be a small amount of money, it may not be worth it. You may just be better off transferring extra payments into the home loan, because quite often there's an annual fee to pay with offset accounts. So that brings us to step 3, which is lender. And once you understand the type of loan that you need and that's going to suit you and your borrowing power, you can then go and sit down with your broker and understand, okay, which bank is going to be most competitive for me for the type of home loan product I'm looking for. And as I said, most of them have the same type of product, so it's really easy to compare. And for example, if you do that with us, we will give you from our panel at least 5 options to choose from, with one that we recommend. So you can get a really clear idea on the home loan that we recommended, why we have chosen that based on what you've told us about your goals and objectives. And then we move on to step 4, which is lodgement. So what happens when you lodge your application for approval? We put a bit of a flow chart together here. Everything in blue is what you do with the finance. So that's what you would do with your broker. And everything in grey is what you would do with your real estate agent, or is to do with the property. And usually you'd have a conveyancer or a solicitor involved to be working in your best interests for all these steps. So you can see step 1, we obtain pre-approval. That will usually last 90 days or 3 months. Once you've got pre-approval, you can then start negotiating on property. And once you agree on a price, you'll sign a contract. Now, even though you're pre-approved, you still want to make the contract subject to finance, because as part of step 2, the bank still needs to value the property. Okay, they want to value the property, make sure it is worth what you're paying for it. If it is worth less, if they value it for less than what you're paying for it, it may mean they need you to provide more deposit. Step 3 is if assuming the valuation is where it needs to be and the bank's happy with it, is where they'll issue formal approval. And that's where you go unconditional on the contract, and because you're happy that you've been able to obtain the finance. One other thing I didn't mention here is this in step 1 is you usually make it subject to building and pest. So step 1, you're making it subject to these things to allow yourself time to get your finance approved, but also allow yourself time to get the house checked for any termites or any structural issues that might be there. And you've got up until step 3 to be able to renegotiate or pull out on the contract if there's something that comes back in the building and pest report that concerns you significantly. Step 4 is the bank will issue loan documents. You usually sign that with your broker, go through that, and that's really their formal issue of finance. By you signing it, you're accepting their offer. You return those, and then your solicitor or conveyancer will liaise with the bank and the seller and their bank to arrange settlement. You don't need to be at settlement. That's done all electronically. But once it does settle, you'll usually get the keys and be able to move in, and your payments will usually start 1 month after that. So that's the process, usually from start to finish, for lodging your application. As I mentioned, step 5 is what we offer, and that is we're with you for the life of the loan. And the way we, the first and biggest thing that relates to is our rate review guarantee. So we'll review your interest rate on an ongoing basis to make sure it stays competitive. And if you do that once a year, we find that each year we can just shave a little bit off your interest rate each time, and that can save you hundreds, thousands in the long run by just getting it reduced every time. Because what we find happens with home loans is banks continually come out with new and great offers for new customers, always trying to attract new customers, and new customers are quite often given better interest rates than existing ones. We can also help you with our mortgage-free program, which is putting together a strategy to try and help you save at least 10 years on your home loan. And also, once you've been in the home loan a little while, you may want to do renovations and require finance for that, or look to purchase an investment property. If you've paid down a significant amount of debt, we can help with that. So also help you with debt consolidation and reviewing your home loan. There may be a better option. It may be worth refinancing your home loan in 2 or 3 years. We can certainly assist with that as well. So I hope you've gotten a lot out of our presentation on first home buyers today. We can also assist investors, as I mentioned, and also if if you do already have a home loan, you're finding the cost of living is too high, we can look at refinancing options to help try and bring your interest rate down. The great thing, as I mentioned, that a broker can offer is a value of walking you through the process. And we do that in our discovery meeting. That discovery meeting is usually 20 to 30 minutes where you can book a free video appointment on our website at a time that's going to suit you, and you can get a really good understanding on what sort of deposit is required, how much you can borrow based on your income and your expenses, what sort of interest rates you're likely to be offered, how long, whether or not you can get approval now or you need to wait, and also what sort of government incentives are available to you. So you can book that appointment. Our website is newbridge.com.au. Jump on there, you can book a free appointment or ring us directly at any time. So as I said, I'm Richard Jeffries. I hope you've got a lot out of this webinar. But really, yeah, the best thing to do is just jump onto that website, our website, book a free appointment and get a really good idea on what your options are that way.